Hello, welcome back. Thanks for your patience here for a couple of minutes. Hope you went and got a nice cup of coffee or a cup of tea and some shortbreads, which would be nice. All right, our next session and our last for the day is Tim Richardson, who's the investment specialist at Pengana Capital Group. Tim specialises in innovative global investment strategies and sustainable investing, with over 25 years of experience in the financial services sector across the UK and Australia. Tim is a CFA charter holder with extensive expertise in banking, superannuation and insurance. And in today's session, Tim will discuss how Australian investors can pursue dividend investments while maintaining strong portfolio fundamentals. So I'll pass over to Tim. Thank you very much.
Thanks very much, David. Thanks for having me on. Perhaps we can move to the next slide, please. That's great. As David said, I'm the Global Equity Investment Specialist at Pengana Capital here in Sydney. We've been around for 21 years and currently manage around $3.3 billion across 14 distinct and differentiated investment strategies on behalf of Australian retail investors. We aim to manage our portfolios responsibly, fully integrating ESG into our investment process. Some of these strategies apply ethical screens. As by way of background, one of these is the Pengana International Equities listed investment company. That's PIA on the ASX ticker. It's the largest ethical international equity LIC on the ASX. We've got a track record of delivering regular, reliable and franked dividends quarterly, which have grown over time. Now, I really hope you got to hear Ian Irvin's presentation just before lunch. I'm sure it wasn't on Ian's mind, but his presentation really set the scene well for this session, explaining how LICs can help Australian income investors. We'll move to the next slide, please, David. So Aussie retail investors very often start with the Australian share market. Australian equities have had a pretty good run over the last decade. This chart shows there's been a lot of volatility, but it's returned 8.6% on average, which has been pretty good for a lot of Aussie investors. Next slide, please. Now, if Aussie shares have been good for investors, they've been even better for income investors. Last year, they were delivering 4.6% dividend yield, which with the franking credit grossed up to 6.2%. Next slide, please. This year has seen the yields pull back a bit. May is the last data point that the ATO have issued. You see there's been a bit of a pullback in yields. Next slide, please, David. I think you can put all of those builds, that's it, yeah. The risks are now growing for the equity markets. Australian inflation has fallen a lot. It's now around a bit less than half its peak, which it reached about 7.8% in the final quarter of 2022. But it does clearly remain stubbornly above the RBA's 2 to 3% inflation target. That reflects the fact that demand is still outstripping supply in the Aussie economy, and a big part of that is the loose fiscal policy. So what this means is the RBA is going to be much slower than some of the other leading central banks in cutting interest rates. Rates clearly are going to fall over time, but not back down to anything like the near zero levels, which we got used to in recent years. These cuts as they come in global interest rates are obviously beneficial, but we should remember they too reflect the fact that the global economy is slowing. Also, trade barriers, tariffs are on the rise. These two factors are going to impact Australian exports, profit, and therefore their ability to pay dividends. China's economy is coming under pressure as it pivots away from capital investment and infrastructure, which has really driven its growth over recent years, to focus on things like clean energy, electrification, and in time also it will move more into consumption. Now, this This theme is impacting the demand for Australia's key commodities, as we see from the iron ore price, which is now back around the 100 level. David, if you're able to move to the next slide, please, that's great. Now this chart, the dark blue lines show the sector exposure of the Australian share market, and the global market is showed for comparison in the lighter blue. Now, if you look at the top two lines, top two dark lines at the top, they show how more than 50% of the Aussie market is invested in financials, predominantly banks, and materials, predominantly the miners. This is a much higher exposure than we see in the global share market, where it's less than 20%. Next slide, please. Now, this concentration is actually even more acute when we look at Australian dividends. Financials and materials account for a full 60% of dividends paid by Australian listed companies. If we add in the energy and real estate sectors, that comes to 75%. So income investors are very highly exposed to these four sectors, which are very sensitive to the economic cycle. Next slide, please. Moreover, many companies in these sectors face quite significant sustainability challenges. Much of the dividends paid depend on revenue that comes from fossil fuel extraction, demand for which is clearly expected to fall over time as the world decarbonises. Now, the speed of this process is hotly debated, but quite unknown. But it's likely that energy and resources company, in any event, will struggle to deliver the earnings growth that equity investors are searching for. And regardless of that, many investors simply wish to invest in sustainable companies which align with their values. Next slide, please. So, by investing exclusively in Australian share markets, this leaves the investors pretty heavily exposed to these four sectors, which are highly cyclical and carry sustainability challenges. Australia represents less than 2% of the global share market. This means that by investing only in Aussie shares, investors aren't going to participate in the returns and the diversification that's available in the remaining 98% of the global share market. Can we move to the next slide, please? Now, not investing globally over recent years would have meant missing out on some pretty great investments, as we've seen. Companies that are critical to the development of artificial intelligence, such as semiconductor manufacturers, TSMC, have been able to grow their earnings really rapidly, and that's been reflected in the share price. But what we're now starting to see is the waves of innovation surrounding AI moving onto the platforms, and now we're starting to see earnings growth also in the software companies such as Adobe, Salesforce, which are developing the AI applications that will help businesses, the enterprise clients, improve the labour productivity and grow their profits over time. Concern around supply chain risk is bringing manufacturing closer to home in North America, European Union, and Japan. So companies such as Schneider Electric of France and Rockwell Automation of the US, they have a fabulous opportunity helping manufacturers optimize their industrial processes and their energy use. And this becomes particularly critical as manufacturing moves to the higher wage cost regions. The aging population and the expanding middle class is driving a long-term increase in health spending. This benefits companies such as Vertex Pharmaceuticals and medical supply groups such as Danaher. And finally, many consumer-facing companies have really struggled in the high interest rate environment that we've seen over the last year or so. But those such as Netflix, with innovative business models, which are able to establish their product as an essential, almost automatic item of household spending, have managed to perform really well. But the key thing here is that these types of investments are much harder to find if we only invest in Australian shares. Move to the next slide, please. So where does this all leave investors? Interest rates are likely to remain elevated, so companies are going to have to learn to live with the higher borrowing costs, even after monetary policy normalises in time. Also, household budgets for a large part of the population are under significant pressure. That's going to impact stocks that are tied to the consumer spending cycle for some time to come. But innovation is going to drive an increase in labour productivity, at least in some parts of the economy, and that brings great opportunities for innovative companies that are positioned to take advantage of this to grow earnings. Next slide, please. Past performance is always a pretty poor guide to future returns, but the current year-to-date returns illustrates benefit of Australia's diversifying globally. Global index has outperformed Australia by over 4%, and that's having outperformed by 8% in 2023. This is clearly way too small a data set to draw conclusions, but global diversification can have benefits. Next slide, please. So with interest rates not coming back to their earlier low levels, consumers are still nervous, but investors should think about their exposure to those really big long-term structural themes, which can help companies that have an enduring competitive advantage to grow their earnings over time. These include things like AI innovation, electrification, onshoring, the expanding middle class, the aging population. Investors need to look for quality businesses that are able to grow earnings throughout the consumer spending cycle. Those with a strong balance sheet that are able to roll over debt, raise finance for new projects in pretty much any credit environment. Next slide, please. But there's a potential problem for Aussie investors investing in global equities. International companies don't distribute franking credits. Next slide. So, but unfortunately, Australian investors do have a potential solution. International listed investment companies, LICs, don't have to pay all of their income each year, so they can smooth their dividend payments to investors over time. Australian domiciled LICs can distribute franking credits. They enjoy the regional and sector diversification that we've talked a bit about, and of course the listing on the ASX provides ongoing liquidity to investors. Next slide, please. So while Australian equities have had a good run, their earnings, dividends, and share prices do face some pretty significant headwinds. Equity investors who fully invest all of their equity exposure in the 1.9% of global shares that are listed in Australia, they're likely to be over concentrated in those four sectors that we talked about. That adds risk to the portfolios, which may not be rewarded with higher returns. But international LICs provide access to frank dividends and a much broader global opportunity set. Next slide, please, David. Just to finish off, one such LIC is the Pengana International Equities Limited, managed by Pengana since 2017, over $350 million in net tangible assets. It's established a track record of paying regular, reliable, and fully franked dividends each quarter. And the chart shows that these have grown over time. Currently yields 4.7% annually, or 6.7% when grossed up for franking credits. Thanks very much.
Fantastic. Thank you, Tim. That was great. Thank you very much for that. A lot of information there. And we have quite a few questions, so I'll start reading through some of those for you. Okay, first question. Isn't this a bad time to invest in global equities as the global economy slows and interest rates remain high?
Well, there's certainly some pretty obvious headwinds out there. Sticky inflation, interest rates trending down but still high and not going to come back down as low as they were. There's weaker household balance sheets, slower consumer spending, geopolitical tensions, and there's the oil price, of course. So what I think is likely to happen is that we're going to see a much greater dispersion in the company earnings between those businesses who are able to grow earnings through aligning to those secular growth trends, which I was just talking about, and those which are perhaps a bit more tied to the consumer spending cycle that may struggle a little bit over the coming quarters. So we think that divergence will be increasingly reflected in share prices.
Thank you. Okay, second question. What are the key risks to the global outlook, especially for income investors?
I think inflation not falling back down to target is the area that's that's probably front of mind. Inflation's come down a long way, but it's not hit the targets in most of the developed markets. So what you might find that's there's effect. It's not a hard landing or a soft landing, but there's no landing. That reflects the fact that the fiscal policy is very, very loose at the moment, just at the time that monetary policy is loosening up as well. So what you might find over time is that we don't get back to inflation targets, which could ultimately mean higher interest rates at some point further down the line. That would bring a recession and a hard landing. I'm not saying that's a likely outcome or the base case, but it is a risk to investors. And probably the other area worth mentioning is of course the geopolitical tensions. You've got a US presidential election coming up in a few weeks. The results uncertain. The Middle East has got some pretty unpleasant challenges at the moment. If that were to escalate and interrupt oil supplies, then we could be back up to $120 a barrel. And of course, there's the very long-term issue of the decoupling between the US bloc and the China bloc, which is something that's not going to go away. So those are the things that we look at.
All right, and just on China, there's a question here. Does China's recently announced stimulus package create attractive opportunities?
I think it's fair to say that the stimulus measures that have been announced will make a difference. They won't be enough to get where the China government wants the economy to be, which is growing at 5% again. Will there be more stimulus? Yes, probably. Will that be enough? Nobody knows. The China government faces a really big issue with with its property market, highly leveraged. Consumer confidence is very, very low at the moment. The property market, where most people store most of their wealth, is simply not moving. So we do need to see more stimulus measures to manage this this cyclical problem. But having said that, David, I think a much bigger and more important issue is the longer term structural problems that the China economy is facing. Firstly, there's the demographics. That's clearly not going to change anytime soon. The weakness in in consumer confidence and consumer spending is partly cyclical, but it's also structural in that there's very little in the way of welfare safety net. That means the savings ratio is very, very high in China, probably way too high. And the priorities of the government in Beijing are such that there's tight control on the allocation of resources, which leads inevitably to misallocation of resources, which impacts on the growth trajectory. So that's having said all that. What does that mean for investors? China's got some fabulous companies, very well run, some of which are appropriately governed. But investors have got to be quite discriminating between companies. Those companies that depend on finance raised on NASDAQ, that depend on access to Western markets, that depend on key components from the US or other allied countries, they've got a potential problem as the global trade system continues to decouple. But having said that, if you can identify companies where the activity and the sales takes place in China, where companies are undergoing activities that align with the priorities of the government, and by that I mean if you're doing things like digitalization, cybersecurity, the Chinese government will probably leave you alone to build your business. But if you're looking at things like video gaming or another sector which may become unpopular with the leadership tomorrow, then investors should beware.
Okay. Now here's one which could be reflective of what a lot of people are thinking. Isn't AI overhyped, overpriced, and best avoided by investors?
The artificial intelligence revolution, if you want to call it that, is real. It's probably going to be the investment event, not just of the decade, but probably our working lifetimes. It will change the economy in ways that we can't imagine. It'll throw out winners that we can't imagine, and probably a pool of losers as well. So this is not a fad that's going to disappear by any stretch of the imagination. The question is, what are the companies that are going to benefit from it? Now, clearly, the semiconductor stocks have had a very good run. There's these are quality businesses that are making real profits. These are cash profits, they're not financial engineering profits. But the concern that I think a lot of investors have, which I think perhaps the question alludes to, is haven't things run a bit far? And they arguably have. Companies, Nvidia's the obvious example, great business, but the share price is now making a consensus assumption on the earnings growth that is increasingly hard to justify. Our own LIC, PIA, we're a long-term investor in that company, and that had a great run. But we've moved away from that because we now think that better opportunities lie in the platforms that are building their AI tools, and increasingly we start to see that those software businesses, I'm thinking of companies like Adobe, Salesforce, those businesses are developing the applications that will enable enterprises to increase their labour productivity over time. Those businesses are starting to grow their earnings, but we haven't seen the massive share price appreciation that we've seen in other subsectors of technology.
Fantastic. Question here about the ever important aspect of sustainability. What screens do you use to ascertain whether the companies are sustainable or not? We
we manage sustainability risks at two levels. Firstly, ESG is fully integrated into the investment process by our investment managers, Harding Loevner, who are based in New Jersey. But the Pengana International Equities Fund has a series of 12 screens to exclude those businesses that we feel have unsustainable business models, and in practice they're perhaps misaligned with the values of our investors. These are or sometimes disparately called the sin stocks. It's mining, alcohol, tobacco, the weapons industry, nuclear, mining, human rights, resources, breaches of animal rights. The full details are available on our website, but those are the main exclusions from the portfolio, and that's there are criteria based on the exposure, which might be a small number of percentage to an absolute total exclusion.
All right, thank you. And one or two last questions. Aren't these AI cloud-based very extended high PI risk?
It sounds like that question alludes to the big platform, the hyperscalers.
Yeah, high PI, high risk.
That's I think there's still value in those businesses. Those businesses are growing their earnings, and as we see more and more software businesses build their applications, the role of those platforms is absolutely crucial, and we can see further earnings growth for a while to come. I'm not quite sure which precise businesses the question's thinking of, but if you look at businesses such as Alphabet, which owns Google, and Meta, which owns Facebook, those businesses are really effectively integrating some AI tools into their operations to drive revenue growth. I mean, if you think about Meta, it's using AI tools to offer a much more personalized experience, which means that the adverts that are placed on its social media platforms much better targeted. They become much more valuable to the advertisers. So, from that perspective, they're using AI to grow earnings. So, we think a lot of those businesses continue to look interesting.
All right, fantastic. Thank you, Tim. I really appreciate you being part of this event today and supporting the ASA and our members. So thank you to you and Pengana Capital for being there. So, and if anyone wants any more information, they can obviously go to the Pengana website. But thank you, Tim.
Thanks so much, David.
Thank you. All right, I'm now going to pass over to Rachel once more to end proceedings. So I hope you enjoyed the day. Thank you, Rachel.
So that's a wrap for day one of the Virtual Investor Summit. Education is all about acquiring new skills and knowledge. We heard a lot today. We heard differing views at times. So I think that's really important to reflect on what you've heard and have your own understanding of what you've heard today and what it means for your investment strategy. Just a reminder that within the app, you'll see a Documents tab, and that's got all of the presentations. Then tomorrow morning, we will send an email and you'll be able to access all of the recordings from today if you're live at this point. So we look forward to day two commencing tomorrow at 11 a.m. Australian Eastern Daylight Savings Time. I think I've got that right. And unfortunately, Olivia Long, who was presenting on AI, is unwell. But we do have David Nord, who is the CEO and co-founder of Pathfinder and has recently been in the AFR around his business and his views on AI. So really looking forward to him kicking off tomorrow. So huge thank you to all of our speakers, our sponsors, our fabulous hosts, the team here at ASA that look after you. And I'd like to thank you for all of the questions that you've provided today to the speakers. So we look forward to seeing you tomorrow, and have a lovely afternoon or evening, depending where you are.